Welcome to the Past the 65 and 66 DVD and also on-demand class. You can purchase on-demand classes by themselves as downloads, or if you buy our DVD set, you get the same content, but you can watch it on your television set, your DVD player, or your computer. We're going to cover economics, fundamental and technical analysis, and try to hit the most testable points. But before we get to the content, why don't we say a few words about the exam itself. The Series 65 and 66 both lead to the same end. It's for people who want to set up their own investment advisory business, or probably more often they want to work as an investment advisor rep for an investment advisor. As you probably know, investment advisors are basically either financial planners or they're portfolio managers. Sometimes they're consultants, usually for institutions. But if you're holding yourself out as being a financial planner, you're going to have to get registered. Some states don't make you take the exam if you have a CFP, for example, or in some states if you're a CPA, and there are others. But either way, you would have to register to be a financial planner or a portfolio manager. And usually you do end up having to take the exam. Otherwise, I doubt you would be watching this DVD or this on-demand class. So the two exams lead to the same result, and they're not the same test, although they have so much overlap. We found it's fairly easy to teach both candidates at the same time. We're at the NASA website. They're in charge of this exam. Even though FINRA administers it through the testing centers, NASA's in charge of its content. It's the North American Securities Administrators Association, as we see here. If you go under Industry and Regulatory, you'll notice that each one of these is a rollover. This is not the easiest website to use, because it doesn't have to be, But under Industry and Regulatory Resources, if you click on Investment Advisors, you'll find a lot of good testable information. I encourage you to go through the FAQs and look at the investment advisor background. This is very testable, and it's just a nice backdrop for what you have to know. In other sessions, we'll look at model rules and a policy statement as well. You could look at the Form ADV that advisors use to register. And I've seen test questions that come from deep into this model custody rule Q&A. Most advisors try to avoid having custody, so this Q&A tells them how they can avoid being deemed to have custody, or if you do have custody, what you'd have to do. Also under Industry and Regulatory, you can click on Exams. And they have Series 65 and 66 resources. Also exam FAQs. Let's see what kind of questions people ask NASA here. How do I sign up? What do they cost? Do I need to have a sponsor? I'll tell you this, the answer is no. Now you can sign up without a sponsor by filing a U-10. That includes the 66, but be careful there because the Series 66 only works if you also have or get a Series 7. Here's a good test question. Does passing an exam immediately qualify me to do business? No. It's just a prerequisite for being licensed, but there are other requirements. You have to do a U4 if you're going to be an advisor rep, or if you passed your 63 after your 7 or 6, you still have to do a U4, and there's a background check, and there are other regulations that you have to follow. So again, passing an exam is a prerequisite. It's not a license in and of itself, and it also works for 2 years after you pass the test. You can use the fact that you passed it within 2 years to register. Beyond FAQs, you could also download the exam outline study guide. And unfortunately, it's not the most detailed information, but if we look here, and then we say Series 65, we could have also clicked on the 66. It tells us for the 65, you answer 130 questions plus 10 experimental, which really just means 140 questions. You have no idea which 10 don't count. You get 3 hours to do it, and I don't know what the heck they're thinking here, but this is no longer accurate. This has been raised to 94 questions and 72%. That's pretty sad because as we see down here, where are we? Should we go back one more? New passing scores. Apparently they didn't tell their webmaster, but the new passing scores are actually 72% for the 65, which means 89 questions out of 130. Got to get them right. And here they jumped from 71 to 75% on the Series 66. They didn't add any number of questions, but they added a few topics, and more significantly, they raised the bar. So, NASA's a bunch of fun people there, obviously. But if you wanted to pull up the exam outline for the 65. You have to do about 7 clicks for anything you want from NASA. And not the most helpful group. But you can get your U10 right here if you want to sponsor yourself for the test. And then down here you could get the study outline. And we're going to start with the first part, which is economic factors and business information, or whatever they specifically call it now. That's what they call it. And there are 19 questions here on the Series 65. Not quite as many questions on the 66, but I still find this information to be essential for both exams. So this is what we're going to cover in this session. Economics. We're also going to talk about fundamental and technical analysis. And as always, we're just going to cover the most testable points. You will never memorize your way to success on these exams. You have to know a lot of background information that you then have to be able to apply to test questions, which is why we're always going to be doing test questions together during this session. And we highly recommend that if you didn't get the full package from us, that you do get the exam cram online. Those are test questions that I add to frequently based on reports from the field, and it's a great way to stay up to date on the types of questions that may show up. But we have to do a lot of background information before we worry about that. Let's start with the business cycle. GDP stands for Gross Domestic Product, and that's the total value of our economic output over the financial quarter for both goods and services. Our economy becomes more and more of a service economy, so basically think of all the haircuts, carpet cleaning, and food that is produced. That's the GDP, the gross domestic product. When they say that the GDP rose at 2%, the economy expanded. If everything's going well, we're in a period of expansion, and we'll look at the various indicators that show us that we're in an expansion. Corporate profits are up, GDP is up, that's almost redundant, and we also see that people are working. But eventually we hit the peak, and then we go into something called a contraction. Sometimes I just call that a decline. And then the test will also say that eventually, at least this is how it's always happened, no matter how bad the economy contracts, eventually it levels off at the bottom, which is called the trough, and then we go into the next recovery. But during this period of the contraction and the trough, how bad is it? Is it a recession? Well, a recession would be a case, these are textbook definitions, so in the real world, the talking heads, not the band, but the talking heads never wait for this to be fully played out. But you'll need to know that the textbook definition of recession is when the gross domestic product is declining for 2 quarters all the way up to 6 quarters. After that, we would call it a depression. But, knock on wood, after the trough, we've always managed to find the next recovery, and the business cycle repeats itself. When we're measuring gross domestic product, we have to factor in inflation because we're measuring the total output of goods and services, but we don't want to kid ourselves that, the fact that the price of eggs went up means that we produce more of them. So we factor it in by measuring inflation, and we do that through the Consumer Price Index. So the CPI measures the basic things that consumers consume: eggs, bread, milk, movie ticket, etc. If the test talks about core inflation, they measure all of the things that consumers buy, except that they exclude food and energy because these are very volatile. Because a hurricane could affect oil production one time, or a frost in Florida could affect food prices, which is just kind of a one-time event. But if they're just talking about the CPI, it includes everything that is worth measuring in terms of whether prices are rising or prices are falling. So the Consumer Price Index tells us that if we see inflation, prices in general are rising, which also means that your dollar doesn't buy as much. And this is a very big concern for senior citizens who just retired. If they have 20 or 30 years to live on fixed income, unfortunately prices can rise, and the dollars that they're receiving from their bonds or their dividends from stock might not keep up with rising prices. So inflation is where we see prices rising and your dollar doesn't buy as much of what you need. What are you going to do? Well, if you can't earn more dollars, you're going to have to back off. And that's why the Fed worries about inflation, because consumer spending is what drives the economy. We could also see a general decline in prices called deflation. And that's good for some people. There are always winners and losers in the economy. But it's not good for corporations, because if prices are falling, we go into a mindset of, well, why don't we just wait another month before we buy anything? And pretty soon nobody's spending. Consumer spending is worth about 70% of gross domestic product. So even though it's fun temporarily to be able to buy more with your dollar, if prices keep dropping, we can end up with a nasty depression, and pretty soon consumers aren't buying anything. So what causes inflation? It's just high demand versus supply, which means that if there's only one bottle of water left and there are 1,000 thirsty people, they're going to bid the price up really high. If we have weak demand versus supply, which is why we track inventory, if there's too much inventory, prices are going to have to drop. We have deflation. So the Federal Reserve Board, we're going to look at fiscal and monetary policy. They enact monetary policy. They're always worrying about inflation and deflation, and we'll see that there are things that they can do to try to manipulate the direction. But they also don't have a big red button where they can just fix everything. Interest rates and yield curves. It's always been on the exam outline. Don't know how much will show up on the test, but that's true of all this stuff. NASA puts out the outline. They say, this is testable. We then infer that, well, if you say this is testable, this probably also is. We haven't gotten a lot of reports that people get yield curve questions, but I wouldn't put it past them. So it could show up. Now, a yield curve, what are we showing? Over here, we have yields on everything from bank CDs to treasury bonds and muni bonds. And over here you have time. For example, T-bills are short term. They're usually 3-month and 6-month. T-notes are in the 2 to 10-year range, so we'll put them over here. And then long-term interest rates, like T-bonds or mortgage rates, are out here. In a normal yield curve, you would expect to earn a much higher yield for locking your money up a long time as an investor in T-bonds. If you're just going to lock your money up for a few months, you don't expect to get as high of a yield. So this is what a normal yield curve might look like. And in the real world, they would be measuring the slope of it, how steep is it between here and here. You just need to know that when things are normal, this can be called either a positive yield curve or a normal yield curve. Yield should go up as the term to maturity goes up out here. So maybe the T-bills are only yielding 1%, but T-notes are more like 2.5%, maybe. And for some reason, you're getting a much higher yield on T-bonds. So it's a very steep but positive yield curve. When things invert, it looks kind of nutty, but suddenly you can get a higher yield on short-term debt and a lower yield on long-term debt. This situation should correct itself, though. Let's put on our thinking caps. Even though we haven't done investment vehicles yet, you've probably read about them in the book, or maybe you've already studied for another exam like the Series 6 or 7. But why would this strange inverted or negative yield curve work itself out? Well, if you're getting higher yields on T-bills, everybody's going to want to buy them, and that buying pressure is going to push their price up and their yield down. If you're getting a low yield there on the T-bonds, people are going to be selling them, which would be dropping their price and pushing their yield back up. Not sure if you can see all that, but know that a normal yield curve is where we get higher yields on long-term debt. If we have a negative or an inverted yield curve, it's a rare situation where you're suddenly getting higher yields on the short-term debt. That should work itself out, though. Now, in the book, we also talk about humped yield curves, where this mid-term or intermediate-term debt security is suddenly getting the highest yield. There are flat curves, which is kind of an oxymoron. But you just need to be aware of the basics here, and I don't think that, even if they had a question here, I don't think they would have 2 or 3. Can't guarantee that. So the Fed is forever worrying about inflation and deflation, and they can try to keep things under control through what we call monetary policy, which has to do with the money supply, obviously. The money supply can be loosened or increased, or it can be tightened. And whether we talk about the Federal Reserve Board or the Federal Open Market Committee, we're talking about monetary policy. The Fed, and you can double check this at federalreserve.gov, they have 3 tools of monetary policy. The first one, technically it's just the discount rate, but they also have a target for the Fed funds rate, and I just want to go ahead and include it. The Fed can just set the discount rate, which is what they charge members who want to borrow directly from the Fed. And then banks can lend each other excess money at the Fed funds rate. They might say for overnight loans in excess of $1 million. The Fed has a target for this, and they can usually achieve it. They can just dictate the discount rate. This is what they do with those policy meetings that the media makes a big deal out of. And the markets make a big deal out of it too, whether it's options, commodities, or stock. The Federal Reserve, right, they can tell banks how much of their own deposits have to be locked up in reserve. Whether it's, they can raise that requirement and tighten the money supply or lower it and loosen the money supply. The tool they use the most is this, open market operations. The Fed buys or sells treasuries, T-notes, T-bills, and agencies, either buys them from banks to pump money into the system or sells it to banks to pull money out. So these are the three tools. How would they use them? In order to stimulate the economy, we would see the Fed cutting the discount and the target for the Fed funds rate, lowering the reserve requirement, or buying treasuries. Really, the way they achieve the Fed funds rate is through this. But how would this work? Well, if they cut the discount rate, you'll probably see rates on auto loans and maybe mortgages go down a little bit, and that'll make it easier for us to go out and buy big-ticket items. Maybe we'll see 0% financing and no payments for 12 months and all that, which could stimulate consumer spending. If the reserve requirement for banks is lowered, they have more money to lend out, and interest rates should drop. If the Fed buys treasuries, they're again pumping money into the banking system. When there's a big supply of something, including money, its price drops, right? So that could get the interest rates to go down and make it easier to buy houses, cars, washers, and dryers. To fight inflation, we don't want to see people lose purchasing power. The Fed will do the opposite. They'll increase interest rates, raise the discount and the target for the Fed funds. They'll increase or raise the reserve requirement, and they'll pull money out of the banking system by selling treasuries to banks, also agencies. All right, so you want to think through this. We don't want to imply you're going to get 5 questions, but you'll get 1 or 2, whether you're doing the 65 or the 66. So they might ask, what are the 3 tools? Or they might make you think a little harder and ask you, what would the Fed do in this case? Or if the Fed did this, how would that affect that? They might even tie it to bond yields. If the Fed is increasing the discount rate, rates up, bond prices should be dropping. And don't memorize everything verbatim, or don't expect it to show up verbatim. I don't know if they're going to say raise the discount rate, increase it. Are they going to increase the reserve requirement or make it more stringent? There are many ways they can say the same thing. Of course, buying and selling, they're pretty well stuck with those two. So monetary policy is the Fed. They have 3 tools. Fiscal policy is different. Also know that the monetarists who enact monetary policy have no control over this. Taxing and spending is done by Congress and the President. You probably, if you listen to AM radio, the talk radio, they often talk about a tax and spend liberal. Well, whether you're liberal or not, if you're in Congress or if you're the President, these are the only tools you have and under fiscal policy. And the Fed can't do anything about taxation, only Congress and President. That way, just like we saw just before the American Revolution, no taxation without representation. The colonists didn't like the way the British government would tax them, even though the colonists had no say. So, obviously when we established America under the Constitution, the only people who can raise taxes would be people that we could vote out of office next time. So how does cutting taxes help? Well, instead of sending these dollars to Washington, this consumer can spend more, and that's going to help the retail sector in our example. They're going to order more product, which is going to help the manufacturing sector, who's going to buy more machine tools and hire more people, maybe pay them more money. They're going to go home and shop as well. To fight inflation, we do the opposite. If we raise taxes, consumer spending would cool down. Or instead of giving out tax rebates or cutting tax rates, remember that the United States government is a major consumer, whether it's for the Department of Defense or education, even the commissaries at those huge buildings buying food and coffee and computers and everything you can think of. They can increase their spending, which in my example would help this manufacturing sector. You could hire more people, buy more machine tools, etc. And then to fight inflation, the federal government could cut back on its spending, which they should probably do anyway. But if they cut back on spending, that would fight inflation because that would cool off, in my example, this manufacturing sector. All right, you may have to know a little bit about economic indicators. First of all, what are the indicators? Well, S&P 500, or they might say the stock market, building permits. If you and your spouse take out a building permit, you're about to buy a house. That's a good sign. If building permits are down, not so good. But the first group we consider to be leading indicators. This data shows up before it's reflected in the economy. If the stock market is rising, that's a good sign. The Fed, though, may start to worry about inflation and have to step in and raise interest rates, sell treasuries, etc. If the market is down, that could signal deflation or just a contraction in the economy that the Fed's going to want to step in and try to stimulate our way out of it. Building permits up, it's a good sign. If they're up too much, the Fed might worry, kind of tap the brakes a little bit by raising short-term interest rates. Building permits being down is a negative sign. There's a lot of economic activity surrounding a new housing project, and if building permits are down, that's not a good thing. The rest, of course, you can read. If the number of hours worked by manufacturing workers is up, it's a good sign, although the Fed may step up to fight inflation. See, when the party gets started over here, the Fed takes away the punch bowl. That's their role, basically. The number of hours down, that's a bad sign. Now, here it gets a little tricky. I didn't do an arrow, you notice. Unemployment claims, we don't want to see those going up. When they're going down, that's a good sign. When people are signing up for unemployment, that's a bad sign. The Fed may have to step in and stimulate the economy. Money supply up, capital goods spending. This is what manufacturing companies buy in terms of, we need a printing press to produce this order. If they're buying more capital goods up ahead, they must have some economic activity that they need to meet the demand for. These are considered coincident indicators. They tell us where we are right about now. Gross domestic product, as we mentioned. Personal income, which makes sense. If consumer spending is such a major part of our gross domestic product, if people are making more money, that's a good sign that they're probably going to spend it. Industrial production is up. Non-farm payroll, we don't want to count the seasonal farm workers, but non-farm payroll is up. That's good. People are working. They're probably going to spend some of their money. Here's another tricky one, though. We don't want to see high inventory levels. If companies are just filling up the warehouse with inventory, they're going to have to start dropping prices and laying people off and all that kind of bad stuff. So when that's down, inventory levels are down, that's a good sign. When they're up, it's a bad sign. So over here, the Fed steps in and taps the brakes by raising interest rates. Over here, they step in by flooding the market with money and driving interest rates down. Corporate profits, of course, we like to see those going up, but these last two are considered lagging. Inventory levels tell us what has been happening at the factory over the past several weeks, and corporate profits are always reporting what happened in the previous quarter. So there's a lot of fair game there for the test, and unfortunately I can't tell you to ignore this stuff. I've seen questions on the exam that say, which of the following is a leading indicator? And I remember the answer was just the number of hours worked by manufacturing workers. That question didn't ask whether the number going up or down meant something, but it implied to me that it could. So you do need to know the basics here. These are not every single indicator, but we've covered most of the bases with this slide. We talked about the business cycle in the first slide, basically, where we had the expansion, the peak, the contraction. These industries, if you bought stock or bonds in these kinds of companies, they would only do well during an expansion. And when the business cycle takes the wrong turn and goes into a contraction, it's going to get ugly. If you look at these products, you can see why. Steel, we're not building skyscrapers, and we're not manufacturing as many cars, et cetera, et cetera. Manufacturing sector tends to do poorly. Durable goods, washers, dryers, people can put off a purchase of that. So when you're holding stock in Maytag or Whirlpool or GE to some extent, you may see some trouble when we go into a recession because you and your spouse probably just keep using the same washer dryer as long as it works. You probably cut back on air travel in a recession, and so would companies. They might do online meetings instead of having a big kickoff at Maui. Automobiles, you're going to probably stretch your car as far as you can when there's a recession. During a recession, people are out of work. They're not out there buying new cars. Heavy equipment like manufacturing and mining equipment. So if you held stock in Caterpillar or John Deere, this might be tough if we went into a recession. Now, if you knew that we were about to get through the trough and go into the next recovery, you could buy these stocks on the cheap and then ride a wonderful wave. I just don't know how you know that. It's hard to predict the future. So if you're trying to avoid getting crushed by the business cycle, you could put some defense in your stock portfolio by buying defensive industries. They produce products that are going to be purchased in both good or bad times. People are still going to buy the basic food, grocery stores. Now, if I were at the test and they said, what about restaurants? I'd say, no, people can back off on restaurants, but as far as groceries, they're going to still have to eat. And they're still going to do all the other necessities of life, and maybe more during a recession. If you're unemployed, chances are, I may see you at the bar munching on some snack food and enjoying yourself a cold beverage and so forth. You still got to buy basic clothing. I wouldn't want to be owning designer suit companies, but for Fruit of the Loom, something like that, blue jeans, you got to replace them, shoes, socks. And healthcare, if you're sick, you got to go to the doctor. If you're on Lipitor, you're going to keep filling your pharmaceuticals, right? So they may call it medicine or pharmaceuticals, healthcare, medical. You got to know the various synonyms, but know the concept that these industries are probably going to do well even if we were in a recession. So that's why they call them defensive. It has nothing to do with the Department of Defense, though. The test may bring up currency exchange rates. And this is a little bit confusing for some when you first look at it. So that's why I went to some great expensive time to put together the slide. What we're saying is our American dollar exchanges into a certain number of yen, and that exchange rate can have a big effect on our ability to export to Japan or import from Japan. Let's say that the U.S. dollar weakens. Or wait, did the Japanese yen strengthen? It's the same thing. So if the U.S. dollar weakens, it sounds bad. But it actually makes it easy for us to export to the Japanese, who can take their strong currency and buy our cheap American goods. So kind of counterintuitive, but we'll show you that again since you did pay your money. If the dollar weakens, there are some negative effects, but it does help our exports. So if we have a trade imbalance with Japan, a weak dollar policy might be what the government goes for to help our exports. If we have a strong dollar, sounds good, but it makes it hard to export to the Japanese because their weak currency can't buy our expensive American products. Now let's go back and review both of these. What we said was a weak dollar helps our exports. What if the test says, well, what would it do in terms of making imports more or less attractive from Japan? If we have a weak dollar, it's going to make it very hard to import Japanese cars and electronics. If we have a strong dollar, it's going to make the imports from Japan into America much more attractive, but it's going to make it very hard for us to export to the Japanese. And of course, we have currency exchange rates with the euro and with other countries as well. And also remember that if we say the dollar strengthened, we also said the yen weakened and vice versa. All right, as I promised, we're going to do some practice questions, so I'll give you a chance to find the pause button and hit pause, do the question, and then when you hit play, I'll break it down for you. All right, so they're not being real conceptual here. This is pure memorization, even though NASA swears they don't want to have a memorization-based test. Whatever. They can say whatever they want, just like politicians. Okay. This is looking pretty good. But I don't like to choose the right answer. I like to say that's probably the right answer, but not until I can eliminate the other three. Well, this one's coincident. In fact, in the real world, some people swear it's actually lagging, but they would never say it's leading. Inventory is lagging indicator. It shows up after something's already happened in the economy. Personal income is also considered to be coincident. There's our answer. If building permits are up, that's a good sign the economy is expanding. If building permits are down, the economy may be going into a contraction. Another one is a number of hours worked by manufacturing workers or new claims for unemployment. Also the S&P 500 or the stock market, however they want to say that. Those are all leading indicators. Which of the following is the least defensive industry? Go ahead and hit pause. And now we'll break it down. Least defensive. They like to use tricky wording to make your experience that much more fun. Aerospace. Well, like what, Boeing and McDonnell Douglas, they do sell to the Department of Defense. These are not price sensitive. People are still going to consume all the necessary drugs that they need. So this is the answer. Well, what's going on here? Well, aerospace, air travel and all that, people back off on that during a recession. So that it's not a defensive industry. And, of course, it has nothing to do with the Department of Defense, which is their cheap trick they're trying to mess with you on. The process of elimination is what's going to boost your score. A lot of people that might have passed the Series 65, with a 69% not too long ago, or they might have passed the 66 with a 72, you're going to have to raise that bar by several questions. And the best way to do it is obviously to study hard, but also to use good test-taking skills. Now, this is a pretty tough question, so go ahead and hit pause. Then we'll break it down. Okay. So they're not saying inventory levels up, unemployment claims up. You have to do that and help the question along. So they would tighten credit if which of the following went up. And you have to say, well, when do they tighten credit? Or what's another way of saying that? Raise interest rates. They do that when the economy is basically overheating, expanding too much, and may blow up. If inventory levels are up, that's a bad sign, right? That's not the time to tighten credit. They do the opposite. They loosen it. These factories have too much inventory. This is going to get ugly. Let's lower the interest rates by pursuing a loose money supply or a loose credit policy. Unemployment claims are up. So I got tricky here. These are the two that move. Remember how the arrows were pointing? These were the two items that went the other way. If unemployment claims are up, we would need some help from the Fed. Is it none of the choices listed, or is it the Consumer Price Index? Consumer Price Index is up. That's another way of saying we're looking at inflation, where your dollar won't buy as many eggs. And you can't usually buy 11 eggs. So you got to have more dollars, which is a problem. So if we see the CPI going up, would they tighten credit? Absolutely. The questions never look exactly like you want them to. You've got to fight your way through them. You've got to use process of elimination. Similar question, only completely different. So if you could hit the pause button, and here we go. They could have said it another way. They might decide to loosen credit due to a decrease in which of the following. It's very easy to get turned around on the exam. Remember that after you give it an answer at the testing center, you either confirm it or you confirm and mark for review. If you confirm it, you're done with the question. If you confirm it and mark it for review, you've got an answer given, but you can go back later if you have extra time. And on the 65 and 66, most people will have a little bit of extra time. Remember, though, if you have to use the restroom, the clock is still ticking. Oh, well. You don't have to worry about everything there. All right, so due to an increase, consumer price index is going up. That means inflation. Prices are getting out of control. You may not be old enough to remember the out-of-control inflation of the 70s and up to the early 80s. Very hard for people to make ends meet. So we've got inflation. It's time to make it worse with a loose credit policy. No. Inventory is up. That's a bad sign. You can't write on the screen, unfortunately. They did give you some scratch paper, though. So if it's a bad sign, it's kind of a bad arrow, too, isn't it? Yeah, well, I have an eraser. I'll fix you. Whenever the economy needs help, that is when the Fed would loosen credit. So that might be the deal. Gross domestic product is up. Well, then there's no need to give it the stimulus of a loose credit policy. It's either inventory or nothing. It's inventory. If inventory is up, the Fed needs to step in and help the economy. It's as simple as that, which really isn't that simple. Okay, so what's the role of the Fed? Now, you don't want to read the question and then look up at the inside of your skull trying to recall what you read in a book. The the people who write the questions know what the books are saying. They'll probably say things a little bit differently. What you want to do is think about what you know about the Fed and then try to find 3 answers that can be eliminated. Setting interest rates for mortgages, they don't do that. And they don't have much influence over long-term rates. Influencing the economy by manipulating short-term rates, like Fed funds. They have a target for that. They can usually achieve it. And they can absolutely set the discount rate that they charge member banks. So, should I choose it? No, I just don't have any reason to eliminate it. Got to be more patient. Providing loans? No. They don't do that. Establishing net capital requirements for insurance companies, that would be the insurance commissioner. Thank you. The answer is B. And that's very close to something I saw on the 65 last time I took it. Doesn't mean it'll be on there again, but what I do there is I don't try to just recreate it verbatim. I say, okay, there are questions like this, which implies there are probably questions like this that could show up. And then we get a little bit of feedback from you, and hopefully you end up passing the test. You know, it's not science here. It's an art, and nobody's guaranteed a pass, especially on the first attempt. And if you want to set yourself up for massive frustration, you know, put all the pressure on yourself that if you don't pass, you know, the world comes to a crashing halt. It doesn't. You know, I have tutored some people who were about to lose their insurance agency. That was usually more on the Series 6 side, but they would have been, you know, this guy was 70 years old, and he would have lost his agency if he hadn't passed the Series 6. That's huge pressure. Luckily, he was still able to do it. Hopefully, you won't have to go that far, but you know, you can take the test as many times as it takes to pass it. If you failed the first time, you'd have to wait 30 days. If you failed again, they'd make you wait 30 days. Hopefully, you'd pass it the third time, because if not, they'd make you wait 6 months indefinitely every time you took or retook it. Well, it could be that hard of a test for some people, but in most cases, it's a combination of hard test, something going on where I'm too busy at work, or I've got a personal issue. Maybe there's a wedding, or a lot of times there's a medical issue. You know, you want to take the test when you're at your best, obviously, but don't put all this extra pressure. You want to go in there, use what you know to try to eliminate 2 or 3 answer choices, and if you're still not sure, confirm it and mark it for review. Maybe you'll have an extra 20 minutes that you can go through what you've marked for review. But you know, it's an imperfect process. It's not always a fair question that you're having to deal with, but you know, you're only being asked to get a 72% on the 65 or a 75%. You don't have to be perfect. Okay, so those are some big points on the overall economy. You do need to know about inflation and deflation, how the Federal Reserve Board can use monetary policy to try to control the economy, and how Congress and President can use fiscal policy. You probably will have to know a little bit about yield curves or not, but I would be ready for it just in case. You probably see something about the value of the dollar. They love those types of concepts that just give people fits and make them feel like they have vertigo. It's just the kind of folks they are. Fundamental analysis is going to show up on a few questions as well, and you're going to hear me say that a lot. It's because that's how the 65 and the 66 work. They don't have a handful of topics that they drill down real deep on. They have a whole bunch of far-flung topics that they only hit here and there. It reminds me of grad school, where you're going to go before the jury of full professors, and you never know what they're going to ask you, so you better be prepared. That's kind of how this works. Hopefully you have some curiosity. I mean, I hate to see that miserable defeatist attitude where people come into the live class, you know, all down, and this isn't fair, and woe is me. I'm not a motivational speaker, as you probably just noticed, but I feel like, look, nobody's forcing you to be in this business. You know, what you're doing is helping people manage their retirement, their educational savings, maybe even something as important as how are they going to deal with a health problem when they get older. You know, you can't take this kind of half-heartedly, and you can't really do the woe is me thing. I don't want a dentist working on my kid's teeth if he or she doesn't know what's going on, and I certainly don't want you dealing with my mom's portfolio if you don't know what you're doing. So you should have some curiosity for things like fundamental analysis, basic economics, so that you can help your clients. You know, and I'm not even in the business like you guys are, but I find this stuff fascinating. You know, no, I'm seeing a therapist. Don't worry. So fundamental analysis, they're not all geeks, but that should help you remember that I'm going to put on my glasses and I'm going to pore over financial statements and I'm going to do my homework on the company itself. So if I'm a fundamental analyst following GE, I'm looking at the business's results. I'm probably talking to their competitors, their employees, and their suppliers. I'm looking at their balance sheet and their income statement. We'll talk a little bit about technical analysis later. Those are traders. They're just following General Electric stock, its movement, its volume, its chart. We're looking at the company's fundamentals if we're fundamental analysts, which I know sounds shocking. So financial statements, the main two being the balance sheet and the income statement. Of course, they have at least 2 or 3 names. Is it the statement of financial condition or the balance sheet? It's either way. Is it a statement of earnings or an income statement? Or is it a profit and loss? Yes, all of those things. But this is what the fundamental analyst cares about. And you need to pretend to care as well. So if they're following the company's revenue and profits, that's obviously a fundamental analyst. A technical analyst would just say, well, the stock's been trading between 40 and 45. That's a whole different school of thought. Price to earnings, price to book, dividend yield, these are all fundamental analyst concerns. Basics of the financial statements. The income statement tells us the results of operations over the quarter or over the year. And they have to report to the shareholders and the SEC. And in that shareholder report, whether it's quarterly or annual, by the way, the quarterlies are called 10Qs, annual, 10K. If they want to get real silly, there are 3 quarterly reports and then an annual. There are not 4 10Qs plus an annual 10K. And sometimes that's the trivia that you'll be faced with on the test. I doubt they'll go that crazy. But the income statement tells us whether they made a profit or a loss, which is why they got clever a long time ago and called it a profit and loss statement. Take the revenue and subtract all the expenses, and hopefully your net income is positive. But a growing company often will be showing a loss for decades, and people will still buy the stock anyway. Amazon, long time, showing loss after loss after loss. Well, eventually they became profitable, and the stock has reflected that. The balance sheet doesn't tell us how they did last quarter. It's what are your assets compared to your liabilities? Are you financially strong enough for us to buy your bonds or make a loan? Or even stockholders. I don't want to buy stock in a company that's carrying way too much debt and eventually may go bankrupt, obviously. I don't think they're going to make us read a statement of cash flows. That would seem to be more fitting for an MBA program. But they might have us add back a couple of non-cash charges to the income statement. We're going to look at this in more detail. Some of these expenses are non-cash. The depreciation of your equipment. Why? Well, if you buy $1 million printing press, you turn $1 million of cash into a long-term asset. You didn't expense it and use it up, right? You're going to have it for, say, 10 years. You would only take 1/10 of its cost as a subtraction on the income statement to depreciate it. That would be straight line depreciation. If you're a CPA, bear with me. I'm just trying to help people get a couple test questions. And we don't really want to talk too much about accelerated depreciation, but sometimes you'll hear Congress or the President say, why don't we allow companies, in order to spur investment in computers and capital goods, we'll let them do accelerated depreciation, where they can take about 5 years' worth of depreciation in the first year. Either way, they're non-cash charges, so to figure out the cash that's being generated, we'll go to your net income, add this back, and call it your cash flow, basically. Let's keep it simple, though. Instead of trying to follow Boeing or ExxonMobil, let's pretend that we're all kids again and we have a lemonade stand this summer. What would our income statement be about? It would start with the top line, which is revenue. We sold $10,000 worth of lemonade. Now, in the real world, that's kind of what it would look like, too, but they'd say in millions or in billions. But we sold $10,000 of lemonade. It didn't just fall from the sky. We had to buy ingredients, which is our cost of goods sold. We had selling, general, and administrative expenses. I think of this as the general officing expense. Yesterday at the gym at Bally Fitness, I noticed that there was a Staples or maybe an Office Depot truck, and I was thinking, what would they be doing here? I'm like, well, this is a business like everybody else. They have toner and paper and office supplies. That's one example of general operating expenses, but labor, selling, all that, your fax machine, your toner, all the things, even the coffee in the break room, the things that are being expensed. Depreciation is a non-cash charge. What they're doing is trying to spread the cost of the printing press in my example, or for us, our lemonade stand and our blenders. They're going to be around for 5 or 10 years, so we should only use up the part of the cost that's related to this quarter or this year. We didn't buy a $500 lemonade stand and use it up. We used up a part of it. That's as far as I want to go there. And again, if you're a CPA, bear with us. Amortization is what you do on intangible things like patents and trademarks. We're down to an operating income that looks pretty healthy. We get to deduct our interest. And this relates to taxation. If you're an owner of a corporation's bonds, they got to deduct the interest they paid you, so you pay your full ordinary income rate. They then they figure their pre-tax income and pay their taxes, and now we're finally down to the bottom line, net income after tax. This is also related to taxation. If you get a dividend from a company, they've already paid tax on these profits, so we usually pay a lower tax rate on dividends. Since the company gets to write off the interest expense, when you receive bond interest, you pay full ordinary income rate. So item by item revenue is another name for sales, and that's the money that we take in on the top line of the income statement. Then we have to deal with all our expenses. For our example, cost of goods sold would be our ingredients and anything that goes into serving up this one glass of lemonade. So it includes the cup itself and the ice, the napkins and spoons. Just like at Starbucks, I think the most expensive part of their product is the cup and that high-tech sleeve that prevents you from burning the heck out of your hand. That would be part of their cost of goods sold. Manufacturers would include labor as part of cost of goods sold, but we don't want to go too far into that. Businesses have general operating expenses. They might call it that, or selling, general, and administrative. This is what keeps all businesses in common. Every business has paper, toner, fax machine, computers, etc. Some of that stuff is general operating expenses. Computers might be considered a fixed asset that gets depreciated, but you get the basic idea. We have to reflect it somehow in the income statement. Advertising is an expense that I pay a lot for Google and Yahoo. My God, I can't get rid of them because that's what drives most of my sales, except for word of mouth. But I did find out that billboard and radio and TV, not right for this small of a niche. If I were selling beer, that'd be different. We're also going to, as I say, depreciate. We're trying to spread the historical cost of the lemonade stand over its useful life. If it's got a 5-year useful life, we're doing straight line depreciation. We'll expense or deduct 1/5 of its cost each year. And then we have to throw it away? No, it's not that tangible. More expenses. We have interest expense, which is tax deductible, just like the mortgage interest that you pay. And then we have to factor in our taxes before we report our profits. Sometimes, I guess, Republicans feel that some of the comments, I don't make too many political comments, but some of the little jokes sometimes tend to go after the right. Let's go after the left a little bit. All those people talking about we should tax the oil companies on their windfall profits. It's like, you mean tax them again? Profits are reported after taxes. If ExxonMobil made $30 billion in profits, what did they pay in taxes already? It's kind of a silly argument. It really is a non-starter. So a company has a profit after tax. Why would you tax it twice? Because we can. No. Net income after tax, or is it the profit or the loss? Different ways of saying the same thing. English majors sometimes have a big advantage, way over finance majors. If they can deal with all the language where you might have 3 or 4 ways of saying the same thing. Is it the bottom line? Is it the profit? Is it the net income after tax? Is it the net income? Yeah, it's all of that. That's the bottom line, baby. So again, revenue is just the money we take in on sales, and they could just call it sales. Excuse me, kind of hit the microphone there. Yeah, we don't go into a high-end production studio for this. It's just not worth it. Cost of goods sold, that was our ingredients. We had to pay for labor and advertising and so forth, and we depreciated our blender and our other equipment, including our lemonade stand, a non-cash subtraction, but we do have to reflect the fact that we did spend money at one time on the lemonade stand. We're down to operating income, and then we get to deduct the interest expense on our bonds or loans, and then we pay tax on our pre-tax income. We end up with an amazing profit of $5,800. If companies could do that, it would be truly amazing to keep 58% of your revenue on the bottom line. A lot of companies show a big loss, especially growing companies. It might take several years before they ever achieve profitability. And before you bought the stock, the prospectus would tell you, we're a new company in a competitive marketplace. There are bigger, better financed competitors. We're currently showing a loss, but I see the future and I want to buy your stock anyway. Okay, as long as you're fully informed of that. Lemonade stand would also have a balance sheet or statement of financial condition. You want to get a loan from a bank, they want to see your balance sheet. You want to take out a mortgage, they want to see your balance sheet. Which, just like for an individual, really is assets minus liabilities. For an individual, we'd call it net worth. For a public company, we call it stockholders' equity. And the difference between what we own, everything from the artwork on the walls, the equipment, the land, the factory itself, everything that we owe, par value of those bonds and any bank loans. The difference is the stockholders' ownership or equity. So just like an individual has the difference between what they own and owe as net worth, on the test I would expect them, instead of calling it net worth for a company, they'd probably call it stockholders' equity. Assets are divided among current, and this is cash or will be turned into cash very quickly. That's why we call them a current asset. We're going to collect from our customers, so those accounts receivable. Definitely those are assets. This is how we back up our line of credit at the bank. They see what your sales are, or they see purchase orders or agreements with companies, and they'll let you use that to back up a line of credit or your inventory, depending on what it is. Long term, we don't intend to sell this anytime soon. We're going to be using this for a while, and this is what ends up getting depreciated: equipment, the building, etc. And then there's some intangible assets. Our lemonade stand wouldn't have any of this, but if we were producing drugs under a patent from Eli Lilly, that patent would have a value, and we'd have to reflect that on the balance sheet. And I would not be able to do that, but that's when you call in the CPAs. Liability is what we owe. So again, assets are what we own. Hope you don't mind that I jump around a little. I just get so excited like Kramer. Liabilities are what we owe. We might owe it in the short run or in the long run. So the interest we have to pay very soon is a current liability. We may have some accounts payable, and of course we will. Our suppliers are eventually going to have to be paid. We may have some wages that have yet to be paid or some taxes that have yet to be paid. Those are current liabilities. Long-term liabilities would be the principal on the bond. So if the bond has $1,000 of par value, that sits as a long-term liability until it comes due finally. But the interest, the next interest payment would be listed as a current liability. And the difference between the assets and liabilities is called stockholders' equity. Some of the items you may see on the test, under stockholders' equity on the balance sheet, they list the par value of their preferred and common stock. And the paid-in surplus means that when they did the IPO on the common stock, they had to come up with some par value for it, which is kind of arbitrary. The amount that people paid above that is listed as the paid-in surplus. So if the common stock has par value of $1 and the test says the paid-in surplus is $9 a share, then they sold the stock for $10. I think they have better things to ask. Retained earnings, believe it or not, would be earnings which have been retained. See, when a company has that net income, if it's positive, they've made a profit, also called earnings, they don't have to pay it out as dividends ever if they don't want to. They can just retain it, buy more equipment, open more stores like Starbucks, buy out competitors like Bill Gates, etc. What kind of profit margins did we have? In terms of gross margin, you take your revenue minus your cost of goods sold, and we had a gross profit of $7,000. And then you just divide that 7 out of the 10. At this point, we're left with a gross profit of $7,000. We started with 10, so we have a gross margin of 70%, which is huge. But we have many more expenses to deal with. When you get down to the bottom line, you compare that to your revenue, and we're keeping an amazing 58% as our net profit margin. Amazing. So net profit is the amount of money. Net margin is the percentage that you've kept. So what does that mean? For every $1 of lemonade we sold, we kept 58 cents. Wow. Starbucks would be more like 8 or 10%. We keep 58. We can dream. Not even Microsoft makes that much. Now, if they talk about operating margin, just take this divided by $10,000, 58.6%. Or what about your pre-tax margin? Take the pre-tax income, divide it by where we started, 58.4%. In the real world, these things are important. We look at the company, if we're fundamental analysts, obviously, we look at their net income after tax, and okay, they made $5,800 or $5.8 million, whatever it is in the real world. And then we have to divide this among the shares. I mean, if you buy a share of common stock, you only share in the profits, so it's time to start thinking about sharing. Doesn't mean we have to pay it out, but you own a piece of these profits. So if there's net income of $5,800 and 1,000 shares outstanding, the earnings per share would just be the 5,800 cut. It's like a big pie cut into 1,000 slices. Each slice has profit or earnings of 580. If last year it was only $2, obviously this is going to be big news on Wall Street. And then we want to see how much people are willing to pay for your stock. That's the PE, the price to earnings. People are willing to pay $58 compared to your earnings. We always have to pay some multiple of the company's earnings because we're forward thinking and speculating. If we were paying a market price of 58, the earnings are 580. It's trading for a price to earnings ratio of 10. And that's what determines whether you're a growth or a value stock. The company that puts together the index would tell you the criteria, but almost everyone would consider a PE of 10 to be a value stock trading cheaply. If it had a PE of 25, 50, or 100, for gosh sakes, which sometimes happens, that's a growth multiple, a growth stock. So fundamental analysis, again, has to do with financial statements, and looking at the company's results of operations, and their financial condition, earnings per share, how much is the stock trading compared to that price to earnings. The book value is the tangible value of the stock, and how much are people willing to pay compared to that book value. The test might call it the theoretical liquidation value. It's like the hard, tangible assets that are tied to each share of stock. How much are you willing to pay compared to that? Dividend payout, especially if you're in an equity income mutual fund. Those portfolio managers would buy stocks that have high dividend payout ratios. So go ahead and let's apply this by hitting the pause button, and then I'll break it down for you. Okay, the way I think, and I've gotten some really high scores, people, on these tests, so I would highly encourage you to use some methods that I've been using. And if I see balance sheet, I say, well, I'm looking for the stuff that's not on the balance sheet, right? I'm usually thinking backwards, which is why I'm able to hang with these guys. So which of the following can be determined by looking at the balance sheet? I'm looking for the stuff that's not on the balance sheet. Earnings, well, that income statement is called a statement of earnings. It's also called an income statement, and sometimes it's called a profit and loss. So just with a little creative thinking, it has to be this. What if you don't know what this means? It doesn't matter. The answer is D. This stuff would be on that income statement, also called statement of earnings or profit and loss. Boom. Process of elimination, usually, if it doesn't eliminate 3, maybe it eliminates 2 choices. Then you're at 50-50, which is better than being at 25%. Which of the following are on the income statement? Go ahead and hit pause. Okay, so I'm doing the same thing now. Income statement, cash and equivalents. That's an asset. It's the top line of your balance sheet. The cash that's in the bank and the short-term debt securities like T-bills and commercial paper that we hold, earning some interest. That's on the balance sheet. I'm drawing a blank with you. Retained earnings. Ooh, that's evil, see? Well, earnings statement. Yeah, but retained earnings ends up on the balance sheet. The earnings that have been retained by the company. Assets. Well, for the same reason here. Get rid of you, and yeah, you're the second line on the income statement. Revenue minus cost of goods sold equals gross profit, and then that divided by revenue is gross margin. So you don't want to just look for the right answer. You want to eliminate the wrong ones. All right, so fundamental analysts would look at the income statement, the balance sheet. He'd be talking about earnings per share, and the company's market share is growing against their competitors. A technical analyst doesn't care about any of that stuff. They just want to know what the stock has been doing and what the stock market has been doing. I think the test on one question just said that the technical analyst studies market data. Yeah, it's data on the stock market, not information about the particular companies. So if you care about where the stock has been trading over the last 52 weeks, you're studying market data. You're a technical analyst. If you're looking at charts, which show the closing prices of a stock over whatever period you just chose. You get a different color. Let's say that at 40, the sellers step in and start pushing the price down. Well, that's where it meets resistance. Maybe down here at 36, it's been attracting buyers who step in to push it back up, and that's what we call support. What we'd like to do is figure out when the next breakout's going to be. So they may integrate something that's kind of tricky. They may want you to say that if the technical analyst sees that resistance is at 40, you may want to place a buy stop above 40. So if you put a buy stop at 41, you're not going to buy the stock until it breaks through resistance, but as soon as it does, you'll buy it. And they might even say that might accelerate a bull market. All these automatic buy orders go off. If it breaks a little bit through resistance, all these buy orders might push it up again, or not. Or you could do a sell stop down here. If it lost support, I want to sell it immediately. Or even if it lost support, sell it short with the sell stop. But we can only go so far into all these. The main thing is to remember, what do technical analysts care about? Bull and bear trends. The market doesn't go up every day. It pulls back. And it pulls back. But that is an uptrend. Markets don't go down every day. They get the sucker rally, and they go down and get the sucker rally. That's a bear trend. Volume, I don't think the test will go too deep into that, but it is market data, and so they would draw different conclusions if they're technical analysts when the stock went up on high volume as opposed to going up just a little bit on decreasing volume. They might think that the bull market is petering out if that happens. 200-day moving average helps us do a little reality check. We hear about the Dow changing so many times, like, well, where are we in the big picture? Well, over the last 200 days, the Dow or the S&P or this particular stock has closed at an average price of X. And so they say, oh, well, then the S&P is way above its 200-day moving average. Maybe it's on an uptrend. Advanced decline is just what it sounds like. If they say it was 3 to 1, well, then 3 times as many stocks went up today as down. If it were 1 to 3, obviously only 1 stock went up for every 3 that went down. I remember when the markets tanked way back in 2008. I think one day I saw an advanced decline line of 1 to 13. So for every 1 stock that went up, 13 went down. Short interest. This is tough. Most people don't like the concept of short selling. What you do is borrow shares from a broker-dealer, sell them right now with the obligation to replace them later. If you can sell them today for 50, and then you're right, and they drop to 30, you could buy them for 30 and keep the difference. So even though those guys are betting that the stock will go down, they're bearish. If you have a high level of short interest, it's actually a bullish indicator, because if 10, 15, 20% of the company's shares have been sold short, which is tough to say, tough to do too, they're all going to have to buy it back at the same time, we theorize, and that could put buying pressure on it. So a high level of short interest is bullish. You've got to think your way through that one. And the odd lot theory says that anybody who buys fewer than 100 shares at a time is not just wrong, he's consistently wrong. So I can get the data on whether the odd lot orders were mostly buy or sell. If they were buying, we're selling. If they were selling, we're buying, right? The little guy always pays too much. So if he finally got in on, way back when, if he finally got in on Cisco at 80, it's time to sell, and vice versa. Now, how many of these have been proven? I don't know if any of them have been proven. I'm sure they all have studies from Ibbotson or other PhDs out there. But you just have to know what they are involved with to pass the exam. So technicals would look like this. Notice how it doesn't tell us about profits at Microsoft or sales or what they do. It's just what is the data on the stock. It last traded here compared to its range over the last year or 52 weeks, however you want to say that. And it closed a little bit above its 200-day moving average. Maybe it's on an uptrend. They also factor in the volume, and you can see it's a very low level of short interest. So there isn't going to be a lot of buying pressure from the short sellers. They could easily cover their open shorts over just 2 days. That has to do with the average volume, et cetera, et cetera. But we can only spend so much time on technical analysis, which should only be 0 to 2 questions. Here's one practice question that I think we'll just do this one together. The 200-day moving average is considered important by technical analysts because A says because it's adjusted for inflationary factors. How? I mean, it's just what the stock has been trading at and closing at. Whose taxes? And you got to think through it and say, too many people panic, like, well, I never saw that before. Well, you're not going to have seen a lot of stuff that NASA throws at you. You got to think logically. Say, now, how could it be adjusted for taxes? Whose taxes? Doesn't even make sense. So now I'm down to these two. One of them says it aids in spotting trends. What's the trend over the last 200 days? Sounds pretty good. Its predictive ability is confirmed by many academic studies. Almost nothing is. The answer is D. Fundamentals look like this. We're talking about earnings and book values and dividends, right, and profits. Technicals were just, the high and low, the volume, the short interest. That's market data. Fundamental analysis has to do with the fundamentals of the company. Company's sales, earnings, book value, dividends, profit margins, etc. Well, good news is for you doing the 65, that is the smallest section. Not saying we covered every single thing, but we covered the fundamentals. For you taking the 66, it's going to be a fairly large part of your test, but your test is so spread out, that you have to know a little bit about everything. Let's do a real quick review, and remember they might talk about the business cycle, which relates to cyclical stocks, which do real well in an expansion, but can get pretty ugly if you own the companies who make washers and dryers and automobiles during this phase. If it's GDP has been negative 2 quarters up to 6 quarters in a row, we're in a recession. After that, we call it a depression. CPI measures inflation and deflation. In fact, I like that one so much. We're going to see that again. An encore presentation of the egg-dollar diagram. If the price of eggs goes up, your dollar loses purchasing power, and then consumer spending goes down, and that slows the economy. But when general prices are falling, people won't buy anything, even though they could. They'll sit around putting off their purchases, and that's not good either. So the Fed, that's why they're always manipulating short-term interest rates. If they see inflation, they're going to raise interest rates. If they see deflation, they're going to lower them. And what causes it? Well, high demand versus supply. There's 1,000 thirsty people in one bottle of cold water. I think the price could get out of control. And if you have a huge supply and nobody wants the stuff, like if there's too much corn produced, you can see deflation. That's why my cousin in Western Illinois is paid to not plant corn over there. We want to, the U.S. government, they don't want to starve the world, but they want to shrink the supply of corn to drive up its price. Anyway. Interest rates and yield curves. This is a positive yield curve. I expect to get a higher yield on a 30-year bond than I would on a T-bill. If it inverts, suddenly I'm getting higher yields on the short-term debt. Oh, we ended up back. Well, there are some good graphics, though. The monetary policy enacted by the Fed has to do with the money supply. They can loosen it and drive down interest rates or tighten it and drive up interest rates. I'm going to go back here, though, to do the review. Remember, these are the 3 tools of monetary policy. Now, technically, you would only say discount rate. But, in the real world, you hear them together. And whenever they say a key lending rate, they're always talking about this. I don't think that, at least right now, not too many banks even use the discount window, but they often use the Fed funds rate. And these all relate to each other. There's a reserve requirement, and you're $1 million short, you borrow it from another bank at the Fed funds rate. And then the Fed can keep the Fed funds rate near their target through their open market operations. This is the most often used tool. This is what they do to stimulate the economy. So if we're seeing that people are unemployed, industrial production is down, et cetera, they're going to stimulate the economy by cutting interest rates. If the economy is expanding too quickly, they worry about the price of eggs getting out of control. They raise interest rates. Fiscal policy is tax and spend. If you cut taxes, that stimulates the economy. If you raise taxes, that'll slow down consumer spending. If you increase government spending, that can help the economy, and if you cut it back, that might fight inflation. There are so many political things attached to this, but we're just doing the economic textbook view. Memorize these economic indicators leading. When this shows up, we know something is up ahead. These are predictive. These just kind of show us where we are now, and these might confirm a recent trend. Corporate profits are telling us what just happened. These do well in an expansion, but really lousy in a contraction, so watch out. These, you don't have to worry about as much. If they sell these products, they can probably weather a recession. Just think of your own budget. You're still going to buy your medicine and basic clothing and food. This is a little tough. We'll go ahead and view it again. If the dollar weakens, it sounds bad. We wouldn't be importing from Japan, but it would make our exports much more attractive. They could buy our cheap American goods. They basically buy our stuff by converting yen to dollars, and they can get a lot of dollars. We'll probably see a lot more Japanese tourists here in Chicago taking photos of the architecture and doing the Frank Lloyd Wright tour here in Oak Park, because it's very much fun for the Japanese to vacation in America when there's a weak dollar. Or is it a strong yen? Yeah, same thing. When the dollar strengthens, we might import more from Japan, but it's going to be tough to sell our goods to them since they won't be able to buy as much of our suddenly expensive American products. Now, that was fun. What else can we review? Boy, that's a lot of graphical information. Then we did these questions. The leading indicator was building permits. The least offensive was aerospace, because these are all defensive that people will buy even during a recession. If these things go up, if which one of them went up, would the Fed then tighten credit? If they saw consumer price index going up, that's inflation, they tighten credit. They would loosen credit if inventory were going up. That's a bad sign. So we're going to help out by loosening credit, expanding the money supply, however you want to say that, driving down interest rates. Their role is just to try to influence the economy by manipulating short-term rates. I mean, that's what it is on this test question. There are probably better ways of saying it. Fundamental analysis, remember, is looking at the fundamentals of the company. Are they financially sound? Are they making profits? We looked at all the items here, and the top line of the income statement is your revenue. Your bottom line is called net income. And I saw an interesting question on the 65 once that said, why do some analysts use price to sales ratio as opposed to price to earnings? Well, the earnings can be manipulated by clever depreciation formulas, but this is the top line. So when you compare the market price to the revenue or the market price to the sales, these are harder to fudge. Even if they were fudged, these would make it even fudgier, right? So I never thought of that way, but that had to have been the answer. You know, when you get the scores that I do, you know that you probably got it right, because you don't miss too many. But anyway, there are so many ways they can spin this. You got to know the basics, but you got to keep moving too. Top line is revenue, cost of goods sold. That was our ingredients. We had general operating expenses. Hopefully we're keeping all this in line. We get to deduct our interest, and remember that taxes come before we report profits. So our profits have already been taxed. When we pay a dividend to you shareholders, you usually don't have to pay your ordinary income rate unless that has just changed recently. Balance sheet is the statement of financial condition. We have current and long-term assets and even some intangible assets. We also, unfortunately, have liabilities, and hopefully we have more assets than liabilities so that we're building stockholder equity like Warren Buffett has been doing for decades. Gross margin is, well, we're left with $7,000 out of 10. We have a gross margin of 70%. We're left with $5,800 out of the 10 we started with. That's a 58% net margin. And then we can see if the stock's expensive or cheap. The earnings per share is obviously $5.80. People are willing to pay 10 times the earnings. I saw a test question that said, what is the price-earnings ratio? It reflects the enthusiasm that investors have for the company's earnings as reflected in the stock price. Yeah, good. Never seen that definition, and you probably won't have seen the definition they throw at you, but they want to see if you can figure it out. Just the kind of folks they are. So again, fundamental analysis has to do with profits and earnings and dividends, whereas technical analysis has to do with market data. I think we're going to wrap it up here, and I would highly encourage you, if you just came through with an on-demand class purchase, consider purchasing more. If you have the DVD, obviously, you're going to want to take a break and then move on to the next session. But either way, if you have questions, you can email them to me at walker@passthe65.com or walker@passthe66.com. Thank you.